Members, I wish each member present here happiest new calendar year 2024. I welcome you all for this study circle meeting on the topic recent developments in the income tax law on charitable trusts. And to develop on this subject, we have CA Bharadwaj Sheshadri with us. Can I request our Vice Chairman, CA Pramod Hegde, our Vice Chairman, to escort the speaker on today's and then welcome him. Members, I have the privilege in introducing today's speaker. Bharadwaj Sheshadri, born in the year 1992 in Bengaluru, to two practicing chartered accountants, Sri K. Sheshadri and Srimati Sunanda P. Sheshadri. Both of them are here. He pursued his articleship with Messrs. Verma and Verma, chartered accountants, Bengaluru, qualified as chartered accountant, and also took a bachelor's degree in commerce. He took a bachelor's degree in law from Karnataka State Law University and obtained a scholarship for securing the highest marks in criminal law. He practiced as chartered accountant between January 2015 and October 2018. He enrolled as an advocate in the year 2019 and has been in legal practice from December 2019. His areas of practice extend to drafting as well as consultancy in matters relating to commercial contracts, Succession Act, the income tax laws, service tax laws, the goods and service tax laws, company law, foreign exchange management law, and many others. Outside the profession, he has a deep interest in Carnatic music and is generally curious about indie fields of knowledge. With this brief introduction, I present before you CA Bharadwaj Sheshadri.
The difficulty with the law governing charitable trusts, the difficulty with the income tax law governing charitable trusts, is that it doesn't fully adhere to accounting principles, neither does it fit into the straitjacketed formulae of computation of income that the income tax law prescribes under the various heads listed under section 14. In that sense, it is a bit sui generis. And for a new student of the income tax law or of accountancy, charitable trust is probably the worst or the hardest field to understand. This can be illustrated with a few examples. Off the top of my head, I am reminded of the unreported order of the Mumbai tribunal in Jastrow Hospital's case, where the question arose as to how you compute the income of a charitable trust. When you are computing the income under section 11, what you are actually doing is quantifying the exemption. Therefore, it is well settled that this income is to be computed in accordance with commercial principles. For these reasons, the Mumbai bench of the tribunal held that provision for doubtful debts would be allowable as a deduction in computing the income of a charitable trust. Now, this is something you would see in accounting and certainly not something you would see, say, in computing income under the head business and profession. Similarly, if you thought that this would lead these provisions to adhere to accounting principles, to that too there is an exception. By and large, the provisions of sections 11 and 12 do not respect this distinction between capital and revenue. Subsection 6 of section 11 is a glorious example of this because it provides that in respect of capital assets, rather depreciable assets, you can either claim deduction for the acquisition of the assets, which is the capital expenditure, or you can claim deduction of depreciation, but you cannot claim both. It is also well settled in law that before the insertion of section 11.6, I think the judgment of the Supreme Court is Rajasthan and Gujarat Charitable Foundation. Before the insertion of section 11.6, you could have actually claimed both the capital outflow and the depreciation as application. So, in order to understand the law of computation of the income of charitable trusts, we must first disabuse ourselves of the notion that it is either accounting or tax. It is neither. The only reason I set out these fundamentals is because the biggest difficulties that practicing professionals face with this aspect of the law is in the fundamentals and the elementary principles. If those are clear, the entire building constructed on that foundation is fairly strong. These fundamental principles were recently somewhat disturbed. Well, disturbed is not a very fair expression. I would say they were altered by two significant judgments of the Supreme Court. The first judgment is the judgment in Ahmedabad Urban Development Authority's case, reported in 449 ITR page 1. The second of these judgments is New Noble Education Society, reported in 448 ITR 594. So, in today's seminar, I will deal with it in two parts. These judicial developments I will deal with first. Secondly, the statutory amendments. After that, if I have time, there is some other case law I would like to take you to. In order to understand the reasoning in Ahmedabad Urban Development Authority, it is necessary once again to look at the fundamentals. The provisions relating to charitable trusts are contained primarily but not exclusively in sections 11 to 13, that is 11, 12, 12A, 12AA, which is now substituted with 12AB and then 13. 11 confers the exemption, 12 deals with voluntary contributions, 12A deals with the prerequisites which would entitle you to claim the exemption, 12AB deals with the procedure for registration, and 13 deals with circumstances in which you would lose exemption. The fundamental provision is therefore section 11. Subsection 1 of section 11 has 4 clauses. A deals with income from property held under trust wholly for charitable purposes. Each one of these words is significant, I'll come to that. Clause B deals with cases where the property is held in trust only in part for charitable purposes. Clause C deals with where the purposes are prosecuted outside India, and Clause D deals with corpus donations, on which also there are some amendments which I will address later. So let us look at 11.1a. The words in 11.1a are income derived from property held under trust wholly for charitable or religious purposes. Each one of these words is the subject of significant dispute. Income I have already dealt with. On the question of property, I am immediately reminded of the decision of the Supreme Court in P. Krishnavarya, where it was held that a business can also be property for the purpose of these provisions. That is to say that the term property is of particularly wide import. This is also supported by subsection 4 of section 11. Then this phrase under trust. Oddly enough, this phrase is used throughout these provisions in various portions. But there is an explanation below section 13 which often goes unnoticed when we read the statute, which lays down a couple of definitions. This explanation has also been amended recently, which I will come to. But the term under trust has been defined there to include any legal obligation. Therefore, any legal obligation, even if it is not precisely an English trust, would fall within the term under trust mentioned here. Therefore, fundamentally, any fiduciary relationship where even a person is a manager of the property, even if he is not an English trustee. So, it is for this reason, for example, that a Madhadipati of a Madha or a Dharmadikari of a religious establishment would also come within the scope of these provisions. Now, charitable or religious purposes, this is where AUDA becomes relevant. Religious purposes are relatively easier to deal with or more difficult to deal with based on how you look at it. Because religious purposes are to be understood with reference to the principles of the relevant religion. Therefore, if I establish a trust to conduct a Kumbhabhishekam of a temple every so often, undoubtedly under the principles governing the Hindu religion, if you consider it a religion, it is a religious purpose. Similarly, if I established a waqf to promote, say, Islamic thought or to promote the Hajj pilgrimage, then that would also be a religious purpose as per those principles. Charitable purposes, fortunately for us, finds definition in section 2, subsection 15 of the Act. I say fortunately, but I am not quite sure how fortunate or unfortunate it is. Charitable purposes, that definition which you will find on your screen, originally, when it was enacted in the 1961 Act, the definition was relatively simple. Charitable purpose includes relief of the poor, medical relief, education, and the advancement of any other object of general public utility, not involving the carrying on of any activity for profit. these words, not involving the carrying on of any activity for profit, are of particular significance. I'll briefly skip to the next slide so that we can understand why. There are three earlier decisions of the Supreme Court which inform us by giving us context to what Auda held. The first of these decisions is that of the Supreme Court in Sole Trustee Lok Shikshana Trust. At this stage, I'll pose a question to you. Why is it that the cause title of this is Sole Trustee Lok Shikshana Trust, and why is it not just Lok Shikshana Trust? Anybody has an answer and is willing enough to answer, please go ahead. If not, we'll just let it pass. Second, Indian Chamber of Commerce versus Consumer Income Tax. And the third is a decision of the Constitution Bench in Surat Art Silk Cloth Manufacturers Association 127 ITR 1. In Lok Shikshana Trust, Justice H.R. Khanna's judgment. Justice Khanna is of course more famous for his dissent in ADM Jabalpur, which cost him the Chief Justiceship of India. Two lines of thought were explored in that judgment. First, what is the scope of the term education as a charitable purpose? Second, what is the meaning or connotation of these last few words of that definition, that is, not involving the carrying on of any activity for profit? In Lok Shikshana Trust, the Supreme Court held that the words for profit, the word for connotes a purpose, which means the activity must be motivated by a purpose which is profit. In other words, there must be a profit motive. This is what the Supreme Court held in Lok Shikshana. This was upheld once again in Indian Chamber of Commerce and also by the Constitution Bench in Surat. But in Lok Shikshana Trust, the Supreme Court went a couple of steps further and proceeded to consider how you can determine in a particular case whether there is a profit motive or not. Amongst various other tests, broadly it said that if you carry out operations on commercial lines, you can say that there is a profit. But one of the things that Lok Shikshana and Indian Chamber of Commerce said is that if profit is in fact earned, that is, in fact or in actuality there is a profit, then we can presume that there is also a profit motive. We will come to the significance of this finding a little later. Then, thereafter, so the Supreme Court said that the question is whether there is a profit motive, and the incidence of profit creates a presumption that there is a profit motive. Indian Chamber of Commerce also held the same thing, but in different language. I think Justice Krishna was a member of that bench, so you can imagine the linguistic excellence with which that verdict was handed down. Linguistically it was excellent, but legally it was fallacious, as the Constitution Bench later held. But in Indian Chamber of Commerce, the Supreme Court went a little further and laid down various tests. One, what is the real nature of the activity? Secondly, whether activities of that kind are ordinarily carried out for gain or not. Thirdly, whether in the constituting document of the trust or institution, there is a provision which prevents profit, or there is a constitutional prescription against profit for that institution. The significance here is that profit motive, as we have always understood it, need not necessarily be the profit motive of the organization or the institution itself, but it could be the profit motive of the managers or owners or promoters of the organization. It is at this point at which things become a little tricky. Let us assume that you are a public charitable trust constituted under a trust deed. That trust deed will undoubtedly provide that the profits of the trust cannot be distributed amongst the trustees or any other persons related to the trust. Similarly, if you enjoy a license under Section 25 of the Companies Act 1956 or equally under Section 8 of the Companies Act 2013, that license itself precludes you, the statute itself precludes you from distributing your profits. So this proposition was not precisely understood by Indian Chamber of Commerce, because it contemplated only a constitutional prescription of the organization in particular, but not necessarily the general statutory provision of Section 25 or Section 8 which prevented it. It is this point on which the Constitution Bench disagreed with and overruled both Lok Shikshana Trust and Indian Chamber of Commerce in Surat Art Silk. In Surat Art Silk, first they held that this position, that merely because you have earned profit, we will presume that there is a profit motive, is incorrect. With this I respectfully agree. Secondly, the Constitution bench held that, this is very important, that these words not involving the carrying on of any activity for profit govern only that last limb, the residuary limb, that is the advancement of any other object of general public utility, and they do not qualify all the other limbs, relief of the poor, education, medical relief, etc. On this also, there is no doubt, until today the law remains unchanged. But the problematic area was when the Constitution bench in Surat's case held that in order to determine whether there is a profit motive, the question posed must be, what is the predominant active object of the activity? If the predominant object is profit making, then the Supreme Court held that there would be a profit motive. But if predominantly your activity is social service or fundamentally charitable in character, then the Supreme Court held that there would not be profit. This predominant object test has held the field in the law for the longest period of time until AUDA said no, this test is not acceptable. This is why AUDA becomes particularly significant in today's tax jurisprudence. Now, so the predominant object test and the test of profit motive, these are the two things which AUDA went on to explain much more clearly. What happened until AUDA? There is one more decision which we must take note of. Unfortunately, I omitted to put it on the slide. Decision of the Delhi High Court in India Trade Promotion Organization. In India Trade Promotion Organization, the Delhi High Court was interpreting the proviso to 215 as it presently stands, which is in the bottom half of the screen. So let's first look at the statute again. Charitable purpose includes, and then you can see various colorful limbs, and then one white limb, bold and underlined. There are totally 7 limbs. Relief of the poor, education, medical relief, yoga, preservation of the environment, preservation of certain monuments, objects, etc. These 6 limbs we have been colloquially referring to as the main limbs, and the last limb is the advancement of any other object of general public utility, which we have been referring to as the residuary limb. In AUDA, the Supreme Court has called the main limbs as per se charity, while it has called the residuary limbs as GPU charity, that is general public utility charity. So both these phrases mean the same thing. I will be using them interchangeably. Now there are 6 main limbs and 1 residuary limb. Now let us read the proviso. Provided that the advancement of any other object of general public utility shall not be a charitable purpose, which means the proviso is performing its ordinary function, which is to create an exception from the enacting clause. The enacting clause says that the advancement of any other object of general public utility shall be a charitable purpose. The proviso says that it shall not, if it involves the carrying on of any activity in the nature of trade, commerce or business. I'll read that again, this is particularly significant. The carrying on of any activity in the nature of trade, commerce or business, or any activity of rendering any service in relation to any trade, commerce or business, for a cess fee or any other consideration, irrespective of the nature of use or application. We'll stop there, at that point we'll come to the rest a little later. So for the proviso to apply, what are the ingredients? See, when I studied criminal law, I learned how to read the law. It's very, very interesting. You break down the things into all its ingredients. Even if you don't understand the law, when you read it as a whole, when you read the ingredients separately, it all becomes very clear. There is a tale that I think, I've just heard it somewhere, I don't know how true it is. Mr. Salve once had a doubt on the interpretation of the section, and he went to Mr. Palkiwala and asked him, how do I interpret this section? Mr. Palkiwala opened the book and read it out to him, and in the tone and tenor in which he read it, Mr. Salve understood how to interpret the section. Anyway, so what are the ingredients for the proviso to apply? First, you must fall under the residuary limb, the advancement of any other object of general public utility. Secondly, that must involve any activity in the nature of trade, commerce or business, or any service in relation to trade, commerce or business. Thirdly, such activity or service must be for a cess fee or other consideration, and we will ignore the rest after that. Then, so this creates the exception. At the end of the first portion of the proviso, you will see the word unless, which means that if clauses 1 and 2 which follow that word unless apply, the proviso will not apply. So clauses 1 and 2 are exceptions to the exception. What does clause 1 say? Clause 1 says that such activity, that is activity in the nature of trade, commerce or business or service, is undertaken in the course of actual carrying out of such advancement of any other object of general public utility, and means it is conjunctive. Both clauses wanted to have to apply. The aggregate receipts from such activity do not exceed 20% of the gross receipts. If I have read this provision correctly to you, then I can consider myself successful if you don't need to read order to understand what the provision says. But my difficulty here is that I don't entirely agree with everything that Auda has said on the construction of this provision. So unfortunately, you will have to suffer me for a little longer because I will have to take you through Auda nevertheless. So, what does Auda say? First, it interprets trade, commerce and business. It places considerable emphasis on the phrase in the nature of trade, commerce and business. It relies on earlier case law and says that in the nature of is not the same as identical to or same as. When the statute uses the phrase in the nature of trade, commerce or business, it means something more than mere trade, commerce or business, which is similar to but not necessarily the same as trade, commerce or business. To put it differently, I hope this reduces the confusion rather than multiplying it. If something is in fact TCB, trade, commerce or business, then certainly it is in the nature of trade, commerce or business. But there could be things which are not quite trade, commerce or business, which are still in the nature of trade, commerce or business. So Auda division bench has held that in the nature of trade, commerce or business means something more than mere trade, commerce or business. Now this only creates one more question. It doesn't really answer anything. Because the question is what are things which are in the nature of trade, commerce or business? That also the Supreme Court has endeavored to explain. I would say that it has ended up explaining the law in a reasonably correct way, although I have complaints with how it has gone about doing it. So it has, one of the first things we study in CA IPCC in determining whether an income is to be taxed under business and profession or other sources is what is business, what is profession, is there a business, adventure in the nature of trade, etc. So the tests which the Supreme Court upheld to determine whether something is trade, commerce or business are the same which we have been hearing for generations. Frequency, continuity, systematic, sustained operations, profit motive. Profit motive also figures here. But that is the test for trade, commerce or business. It is not the test for anything in the nature of trade, commerce and business. So the Supreme Court has said, although not exactly in these words, that profit motive is not a relevant test now to determine whether your activities are in the nature of trade, commerce or business. And the reason it has said this is very interesting. If you look at the statute as it stood when it was originally enacted, the last words were not involving the carrying on of any activity for profit, which means profit motive was expressly included in the words of the statute as a test. If the Parliament has subsequently removed profit motive from the words of the statute and inserted activities in the nature of trade, commerce and business, the presumption is that it is not the intention of Parliament to reintroduce profit motive as a test once again. This is presumably what went through the minds of the Supreme Court in Auda. I don't want to comment on whether I agree with this principle, but this is the law now. So Supreme Court has said that profit motive is no longer relevant because it is no longer test. Now, therefore, the second test which Surat Constitution Bench laid down was that of predominant object. If your predominant object is commercial or profit making, then Constitution Bench in Surat said that you would not be charitable. But if your predominant object is not that, then you would be charitable. Now Auda says that this predominant object test is also no longer relevant. Because if you look at the proviso as it stands now, it has nothing to do with your object. It says, are you carrying out any activity in the nature of trade, commerce or business? I am not interested in what your object of that activity is. So now Auda says that profit motive is no longer relevant. There is only one complaint I have with this interpretation. I have not formed an opinion whether I agree with it or not. But I have one complaint with the interpretational process. The Delhi High Court in India Trade Promotion Organization had held in 2011 or 12 that this proviso is unduly wide. Therefore, in our opinion, it is unconstitutional. But when a High Court or Supreme Court finds a provision to be unconstitutional, the first endeavour will be not to strike down the provision immediately, but to attempt to read it down in a way that it becomes constitutional. So the Delhi High Court said, we will not strike down the provision, but we will read it down. How will we read it down? We will say that trade, commerce or business necessarily means profit motive. Therefore, even if you ignore the Constitution Bench judgment of the Supreme Court for a moment, on the strength of the Delhi High Court judgment in India Trade Promotion Organization, profit motive was still a test in determining whether trade, commerce or business existed. The Supreme Court, in holding that profit motive is no longer a test in AUDA, has not actually reversed the findings of the Delhi High Court India Trade Promotion Organization. Because before the Supreme Court in AUDA, in that batch of matters, I'll tell you what happened. The judge who passed the order in India Trade Promotion Organization, Justice Ravindra Bhatt, was also on the bench of the Supreme Court, which was to hear AUDA. When India Trade Promotion Organization was batched with AUDA. So when it came to the notice of the bench said, let's detag ITPO. We'll hear AUDA and the other batch matter separately. We'll hear ITPO separately, and Justice Ravindra Bhatt is not a member of the bench. So when AUDA was heard, ITPO was not a part of the batch. AUDA interpreted 250 this proviso, disregarding profit motive as a test, but the Supreme Court has today not actually overturned the constitutional reasoning which the Delhi High Court has applied in ITPO. When ITPO was carried an appeal to the Supreme Court subsequent to AUDA, Supreme Court said ITPO is covered by AUDA, therefore AUDA is also reversed. So we have actually no answer as to the constitutionality of these provisions, although Delhi High Court has expressed to be voted. Anyway, be that as it may, that is the law. So having held that profit motive is not a test, the question then is, how do you determine once again whether something is trade, commerce or business or not? It is in that context that the Supreme Court went to the next criterion, which is cess, fee or fee, cess or other consideration. In determining what is fee, cess or other consideration, the Supreme Court said, the Supreme Court categorized assessees into various classes. Firstly, there are statutory bodies, for example, port trusts, or certain port trust is the best example. We will stick with that. The Institute of Chartered Accountants of India is another example, and its matter was also tagged with AUDA and disposed of by the Supreme Court. There are findings on ICA separately in the AUDA judgment. Then there are non-statutory private NGOs of any of the charitable trusts for which you are struggling with Form 10B and 10BB. So, in the case of statutory bodies, the Supreme Court said that when the statute itself mandates that the body must collect a certain fee, then that fee cannot be considered cannot recharacterize the activity as being in the nature of trade, commerce or business. So Supreme Court said that the words fee, commerce, cess or other consideration must be interpreted purposively, and therefore where it is a statutorily mandated fee, we will not treat it as trade, commerce or business. In my view, this logic is not sound, but this is the law. Second, in the cases of bodies like the ICI, in fact in ICI's own case, in AUDA, the Supreme Court held that the ICI charges fees for coaching classes and other similar services. It said that these fees are charged at a nominal markup or at cost, and therefore it is not in the nature of trade, commerce or business. This is where things get a little murkier. Having held all this, the ultimate reasoning that emerges from AUDA is that in order to determine whether an activity is trade, commerce or business, in the case of a charitable trust or institution which is not a statutory body, the test is whether the markup the markup which is built into the fee, cess or consideration charged by the assessee, not by the assessee, by the trust or institution, because trust is not an assessee. The fee, cess or consideration charged by the trust or institution is at a nominal markup or at cost. If it is at a substantial markup, then it is in the nature of trade, commerce or business. If it is not at a substantial markup, it is only at a nominal markup or at cost, it is not in the nature of trade, commerce or business. This is the reasoning in AUDA. The next question I am scared that you might ask me is, what is nominal, what is substantial? To that there is no answer. Supreme Court does not answer that question, and to be fair, you cannot expect the Supreme Court to answer the question. the moment if you read this charitable trust, the charitable purpose definition, fundamentally the test is subjective at some level. There are arguments against that which I might come to separately if the occasion permits. But there is only so much that a court can do to make things clearer. At some point the test is subjective, and it is precisely at that point that the department will initiate litigation. So, how do we learn from this in practice? If your charitable trust comes under the main limbs, that is per se charity, and not under the GPU limb or residuary limb, you have nothing to worry about. But henceforth, always it is very significant to have documentary evidence to ensure that you are consistently under the main limb. For example, relief of the poor, I will give you a very simple example. The relief of the poor, do I have to prove that all my beneficiaries are below the poverty line? Answer is no. Again, test is subjective. Let us assume all my beneficiaries are below the poverty line. Do I have, if one of my beneficiaries does not have a BPL card, do I cease to be relief of the poor? Answer is no. Subjective. There is no objective principle there. So you have to have evidence to show that you are under the main limb. And in the context of main limb, we are dealing with the new noble right after this. That will add to the difficulties, not to the confusion, but to the difficulties. So this main limb residual limb categorization is very significant. If you are under the residuary limb, the easiest way for you to get out of the proviso is to ensure that you don't fall within the definition of this trade, commerce or business, which means that you should ensure that the consideration you charge is either at cost or with a nominal markup. Now, this I think is overall a fairly reasonable conclusion to reach in practice, although its theoretical foundations may be slightly shaky. So I have read this judgment 3-4 times, and I've read section 215 at least 25 times in the last month. But now, as I'm speaking, one more thought occurs to me. Under section 11(1)(a), you are allowed to accumulate 15%, no questions asked. If my markup overall is within that, if my bottom line, overall the surplus is within that 15%, can I not argue that ipso facto my markup is reasonable? It is nominal. I think that's a good argument. If any of you have cases on which the department will eventually argue this, that's a useful test. You know what the department will argue? They will say that if it crosses, the moment it crosses 15%, they will say our markup is not nominal, it is substantial. That argument is incorrect. So that is the argument we'll have to defend. Next, it said, the proviso as it now stands, says that irrespective of the purpose for which this fee cess of consideration is utilized, we will treat you as charitable or non-charitable, which means you can apply this fee cess of consideration for any purpose. But that will not go to determine whether the activity is charitable or not. Supreme Court has virtually upheld this in the same words. There is not too much controversial about that. But for those of us who are familiar with the law as it stood before Auda, there is a decision of the Supreme Court in Tandi Trust's case. 247 ITR 785. I am not very good at remembering all these citations. Principle is easier than wrote in my view. So, Tandi Trust held. So there are two cases, Tandi Trust and Adityanar charities, which also I will refer to later. This Tamil newspaper Dinatandi, the will of one individual required that certain property of his estate be settled upon a trust. That trust must carry on various activities, and those activities must necessarily fund education. This is Adityanar's case, which is related to Tandi Trust. Similarly, in Tandi Trust's case, the trust was carrying on the operations of running a newspaper, which broadly it has been accepted as not charitable. There is a decision of the Punjab and Haryana High Court recently in Tribune Trust's case. There is an old decision, wonderful decision of the Lahore High Court, I think it was, in the Tribune Trust's case, which was reversed by the Privy Council. Both of those judgments are wonderful to read. I believe the Privy Council was wrong. Where newspaper publication, it has been held is not necessarily charitable. So the question that arose in Tandi Trust is, if I run a newspaper, but use all my surpluses only to fund education, am I carrying out education, or am I falling under the head any other object of general public utility? Supreme Court in both so in Tandi Trust, the Supreme Court said that if you run a business and that business feeds a charity, you are still charitable. Because section 215 and section 11.1 don't require your activities to be charitable. They require only your purpose to be charitable. So let us forget all these judicial developments for a moment. Let's say I set up a plant in which I manufacture tires or I manufacture automotive cables and I sell those cables and I earn a profit out of it. But that profit, by my constitution document, by my MOA, say I'm licensed under section 8, are to be used only for promoting education. Here my purpose is certainly charitable, although my activity is not charitable. This is the position that Tandi Trust considered in holding that a business feeding charity is okay. Now, because of AUDA and the manner in which the proviso is presently structured, business feeding charity is not permissible, assuming you are in the residuary limit. If you are in the main limit, you can still do it. Now, this is the next. So, to this extent, this profit motive test, which was laid down by the Constitution bench in Surat, is no longer relevant. There are quite a few tax practitioners who are very irked at how a two-judge bench of the Supreme Court can overrule a Constitution bench, which is of 5 judges in Surat. There has been no overruling. The law has simply changed. When Surat interpreted the provision, it says not carrying on any activity for profit. Now that for-profit test is not there in the statute, so the law has changed. The predominant object test laid down in Surat, that has also been effectively negated by AUDA. So this is primarily what AUDA has held. This is the main first principles reasoning. After this, there are some minor points which I'll quickly take you through. So I'm a big fan of first principles, and I think one of the most important first principles in income tax law is if there is any judgment by Justice M.C. Chawla, you have to read it. Those judgments are timeless. There is a judgment of the Bombay High Court, Justice Chawla and Justice Tendolkar, in Breach Candy Swimming Bar Trust 27/80/279, which described what charity is. It said that charity doesn't mean giving something for nothing, or subsidizing something, or dole free of charge. It said that charity does not necessarily contemplate the eleemosynary element. Unfortunately, now not only will you have to listen to me, you are forced to look at me. Because, anyway, so the Honorable Bombay High Court held. Honorable Bombay High Court held that the eleemosynary element is not a necessary ingredient of charity. This has been once again affirmed by the Supreme Court in AUDA. Our Honorable Karnataka High Court in CMR Nyanadhara Trust's case a few years ago has also upheld this proposition. So, free or subsidized or free dole is not an essential element of charity. Then, in AUDA, the Supreme Court considered various categories, as I said, statutory bodies, non-statutory bodies. It also considered one category, that is trade promotion bodies. For example, it considered the case of one entity called GS1. GS1 is a not-for-profit organization, but it is the organization which holds rights over the concept of barcodes. So GS1 and also organizations like CII and similar organizations. In those cases, the Supreme Court said that trade promotion bodies, to the extent that they are carrying out activities which is just dissemination of information, promotion of trade, etc., those would all not be in the nature of trade, commerce or business. But if you are letting out halls for functions to take place and earning rent from that, that would be in the nature of trade, commerce or business. So not only do you have to consider the nature of the institution, but you also have to consider the nature of the activity in that particular transaction which is being carried out by the institution. Similarly, I gave the example of GS1. Another example is NIXI, the National Internet Exchange of India, which is also similar principles. In the case of cricket associations, the Supreme Court said the facts are very complicated. We are remanding it back to the High Court for fresh consideration in accordance with the principles. So, this is broadly what AUDA held. It is held much more in detail. I will give you one cheat code, which is paragraph 253 of the judgment, is a summary of all the conclusions reached in the judgment. Personally, I strongly disapprove of this practice of recording summaries in judgments, because the recording of a summary presupposes that the recording of everything else was not important enough for the reader to read. And as a judicial forum, you must have at least that much security to presume that every word you speak is relevant, and everything else cannot be omitted to read the summary. Summaries are very dangerous business. In fact, the best example of a summary going wrong is the decision of the Constitution bench of 13 judges in Keshavananda Bharati's case. 13 judges recorded judgments of thousands of pages. Obviously, most people would not read it. Then the judges came together and said, listen, let's write a summary. This summary was much briefer, but only 9 judges even agreed to sign the summary. So the summary itself is of doubtful authority. Fortunately, none of us read those judgments. So whether the summary is relevant or not itself is irrelevant. Now, one CA once posed a question on this issue. Let us assume that my activities fall under trade, commerce or business within the meaning of the proposal. If that is the case, do I have to offer that income for tax under section 28 to 44, etc.? Will it be profits or gains from business? Dangerous question. The answer to the question is no. Because the Supreme Court has interpreted trade, commerce or business, which is a phrase which specifically occurs only in the proviso to section 215. It has not interpreted what is a business for the purpose of the charge under section 28. And for that the test is still thankfully profit motive. So the reason this profit motive test is discarded is because of this trade, commerce, business test. The effect of the trade, commerce, business test is even if you are a charitable trust, even if you have a prohibition from distributing your profits, still you have to be able to get caught under that provision. But in the case of a business, admittedly the question is whether some private gain is contemplated. Private gain versus trade, commerce and business are two different things. Private gain is a trust laid down by the Chharla and Breach Candy Swimming Bar Trust. I think we'll stop. I can go on with Auda. Let us go to New Noble. New Noble dealt with section 1023C. I and our offices have generally been advising assessees for the longest period of time never to go under 1023C because anyway the exemption would be available to you under section 11 read with section 215. I remember when I was an article clerk in the first year, I carried out an audit of a charitable organization, one eye hospital, and there was a very heated argument with my principal on whether they should opt for 1023C or section 11. So I sat and tabulated all the differences between these two provisions. 1023C is a real pain. If for nothing else, every section, subsection and clause which is there in 11, 12, 12A, 12AB, 13, etc. is in the nature of a proviso. So there are some 17, 18 provisos to 1023C. So not only are you protecting your assessee by advising them not to go under 1023C, you are also protecting yourself from the trouble of reading those 17 provisos and keeping count of which proviso is which. You must remember that a proviso will periodically get removed and a new proviso will get inserted. Then whether the 13th proviso is the old 13th proviso or the new 13th proviso, and whether the count starts from one as on today. So many complications are there. But more seriously, the reason you should not resort to section 1023C is that which New Noble has wonderfully demonstrated. So 1023C has various clauses. All kinds of educational institutions, hospitals, those funded by the government, those not funded by the government. Then PM CARES Fund, Prime Minister's Relief Fund, Swachh Bharat Course, Clean Ganga Fund, all of them have various provisions. In some cases not directly, all not relevant. The relevant clauses for non-government, non-special entities are clauses 4, 5, 6 and 6A. If I'm right, I might be wrong, but clauses 4 to 6A, roughly those clauses. Let us look at 1023.6, which is reproduced on the screen. Any university or educational institution existing solely for educational purposes and not for purposes of profit. See, any layman who reads this section, and there is an advantage in the taxation laws. I'm sorry I'm getting distracted, but all these academic tangents are worth it in the long run. There's a decision of the Supreme Court in Jaswant Singh, Charan Singh. That was the case of a colliery which processed coal. The question there was whether charcoal would fall within the definition of coal. The Supreme Court said that under the colliery control order, charcoal would not be coal, because a colliery control order is to be uses technical words in the technical sense. But for the purpose of the UP Sales Tax Act, charcoal would be coal, because sales tax enactments are to be interpreted as a man of commerce would interpret it. So in the same judgment, the same word has been interpreted in two different ways based on the statute in which it appears. But so a taxing statute will be interpreted as an ordinary man of commerce. You can say as a layman would interpret it. Any layman will tell you that this word solely and the words not for makes it very clear. If you have even one object in your trust deed or bylaws, memorandum of association, which is not an educational object, then you cease to be existing solely for educational purposes. This to me is apparent from a very plain reading of section 1020. Simultaneously, not for the purpose of profit means that even if there is a slight immaterial part of your operations which is motivated by a profit motive, you would fail the test. New Noble Supreme Court has finally laid down this law. The Supreme Court, with deep respect, has been consistently incorrect in a line of decisions where, again, just like in Surat's case, they have held that you must consider the predominant object. Is the predominant object profit making? If not, you can come under 1020. If you read it that way, then what is the meaning of the word solely? And what is the meaning of not for the purpose of profit? Now, this, so again, sole trustee, low sectional trust, which we have already seen, was a case under 1023C. Adityanar Educational Institution is a very interesting case. I referred to it a little earlier. It was a case where the assessee institution itself was not carrying on any educational activities. It was merely raising money and passing on that money to educational institutions. Department argued that it is not an educational institution, it is merely a financier. How is it different from an NBS? How is it different from Tata Sons Limited? Supreme Court said, see, that is a hyper-technical view. You can't take such a hyper-technical view and say that exemption is not allowed. Secondly, again, the test is not activity, the test is object. I can do whatever I want. If my object is education, I am entitled to exemption. So, remember, the problem with practitioners who are familiar with the income tax law and charitable trusts is that the GST law is the complete opposite of this. Because the GST law does not care about your objects. It is only concerned with your activities. Therefore, you could be exempt in respect of a particular supply if the notification contemplates the exemption. But you might not be exempt in respect of another supply, whatever your object may be. So, Adityanar. After that, both in Oxford University Press was a case where the question was whether a press which was publishing books for a university would be education. Supreme Court said yes. American Hotel and Lodging Association. Now, when it reached American Hotel and Lodging Association, there is this principle called stare decisis, which says that even if the law has been consistently interpreted in one way for a long period of time, even if that interpretation is wrong, so as to not disturb things too much, we will continue to interpret it that way. American Hotel and Lodging did not apply stare decisis, let me be very clear. But my suspicion, and this is only speculation, is that this is what went through the mind of that judge. Because he reproduced Surat, American Hotel Lodging, Adityanar, Oxford University Press, and then summarized what are the principles, and there he upheld the predominant object test. And he upheld the test of profit motive, which continues to be relevant. So, what New Noble now, I mean, in this context, we can see what New Noble did. Very simple. Plain grammatical meaning of the word solely. Solely doesn't mean almost completely. It doesn't mean primarily. It doesn't mean predominantly. Solely means to the exclusion of everything else. So, in New Noble, Supreme Court has said, if you are seeking to make a claim under Section 1023C, you cannot have a single object in your trust deed which is not for educational purposes. You must exist solely for education. And secondly, you cannot exist for the purposes of profit. Surat Supreme Court has rightly held in New Noble that Surat was, the judgment in Surat was handed down in a different context, because in section 215 the word used is not for the purpose of profit, which means that profit motive is expressly a test and predominant object, you can arguably bring it in there, but where the word solely is used in 1023C, that reasoning does not apply. So, New Noble is fairly simple. My difficulty is, as the professional community, we must be willing to dispassionately appreciate and accept a decision which is against the SSC and respect it. If we make adventurous claims by interpreting New Noble and the law in a cavalier fashion, you will end up in trouble. You cannot adopt a Maidan hai ghoda chalayenge attitude. You must, at the stage of making the claim, you must wonder whether the claim will be tenable. And things have just gotten significantly difficult for institutions registered under 1023C. The saving grace of New Noble is that it appreciated this difficulty and said that this will apply only to assessments in the future, which means it impliedly did what is called prospective overruling. Whether the Supreme Court has the power to do prospective overruling is a whole different dispute which is beyond the scope of our syllabus. Now, the other aspect that New Noble went into is the question of what is the extent of the power of the Commissioner in considering the question of approval under 1023C. There was an argument from the SSC that 1023 says you must exist solely for the purpose of education, not for the purpose of profit. So the Commissioner has to look at my trust deed and stop at that. If I am not carrying out activities in accordance with my trust deed or MOA subsequently, feel free to deny exemption in the assessment for that year. But in granting approval, your inquiry must be limited to this. Supreme Court said no. Supreme Court said that if there are activities which have already taken place, why should the Commissioner not look at it to determine whether in fact you are existing solely for educational purposes and not for the purpose of profit? I will reserve my comments on whether I think this is correct or wrong. There is a public policy interest in interpreting it this way, and there is a statutory interpretation principle in interpreting it the other way. It's complicated. I don't think there's a very clear yes or no answer. But the Supreme Court didn't say the Commissioner can look into anything. The Supreme Court said the inquiry of the Commissioner must be limited to the past accounts of the SSC to determine the nature and purpose of the income, full stop. So you can read my memorandum of association of objects or trust deed. You can read my past accounts to determine nature of income and objects and stop at that. Right? So then incidental surpluses. In Indian Chamber of Commerce and in Lok Shikshana, the proposition was if you had earned profit in a year or two, there would be a presumption that you had the profit motive. Surat overruled this. Auda now says that profit motive itself is not particularly relevant. At the same time, it says, listen, if there are incidental surpluses arising in some years, the Commissioner should not give disproportionate weight to those incidental surpluses in determining whether to grant registration or not. Commissioner is not saying that you can ignore the incidental surpluses. So essentially, what this has the effect of increasing the discretionary power in the hands of the Commissioner. It is a cardinal principle of administrative law that the entire object of administrative law is to reduce discretionary power and narrow the scope of discretionary power, and this tends to operate in the opposite direction. But presumably from a construction of the statute, no other conclusion could have been reached. So this could cause some difficulty at the stage of registration or approval. But by and large, we know that the commissioners are inclined not to grant registration, and typically you get registration before the tribunal. If you are regularly successfully getting registration before the commissioner, please tell me the secret of how you do. So that brings us to the end of the two significant judicial developments. There are some other judicial developments, we'll come to later at the time. Now, various amendments have been made to the statute where whatever we have understood as being the computation of charitable trust over a period of years, I'm relatively younger, so what am I saying? But senior professionals have understood for say 20, 30, 40 years if you've been practicing. All your first principles of how you compute the income of charitable trust are now disturbed. A large number of amendments have been made with respect to corpus. As I said, section 11.1 contains 4 clauses, A, B, C, D. D deals with income in the nature of voluntary contributions with the direction that they shall form a part of the corpus. I will read that provision because it is particularly relevant to some decisions which have, in my view, been wrongly rendered. Income in the form of voluntary contributions made with the specific direction that they shall form a part of the corpus of the trust. Now earlier, this requirement of 85% application applies always only to income falling under 11.1a, which is non-corpus income. So if you receive 100 rupees of normal non-corpus receipts and 20 rupees of corpus receipts, you would have to apply only 85% of 100, which is 85 rupees. Let us assume that you have only applied 80 rupees. But out of that 20 rupees, you have applied another 10. Some assessees were treating the application as 90, which means application out of corpus covered by 11.1d was being treated as application out of 11.1a income. This, in my view, was never permitted by the law, although the law never said so. Now, the Act itself has been amended to say that when application is made out of corpus, you cannot claim it as application, but when you replenish the corpus investments within 5 years of the actual application, in the year of replenishment, you can claim it as application. Many people came to us having read this provision, saying that they have made the law stricter. The answer is no, the law has actually been liberalized. Because until this provision was there, whether in the year of the outflow or in any subsequent year, you could not have claimed it as application. Now the law at least permits you to claim it as application in the year in which you replenish it. This is an amendment which has been made by means of clause 1 to explanation 4 to section 11.1. This is an amendment with effect from 1st April 2021. In order to make this claim for application in subsequent years, there are various conditions. I will leave it to you to read those provisions. I don't want to go into that in depth. It's fairly easy on a plain reading. The application should be only in India. The application can only be considered on cash basis, etc. etc. But 11.1d has itself been amended to say that in order to claim the exemption, so what we have understood till now is that corpus is exempt ipso facto. In order to claim that exemption, it must, in the year in which it was received, be deposited in the mode specified in 11.5. 11.5 modes you are already familiar with in the context of accumulation under 11.2. Just to clear the air, it would include savings bank account with the scheduled bank, fixed deposit with the scheduled bank, current account with the scheduled bank. Now, this itself you are always doing. Where is the question of not complying with it? The significant requirement is it must be in a 11.5 mode maintained especially for corpus. Therefore, theoretically, if you have a savings bank account into which you are collecting all your donations, theoretically, corpus donation should not go into that savings bank account, should be in a separate savings bank. This is actually what the text of the provisions require. But in practice, is this very hard to implement? Yes. But is theory concerned with practice? No. But what typically would happen now in practice is that you will have a common account into which all donations flow, and immediately you transfer corpus donations to another FD or savings bank account which is maintained especially for that purpose. My only submission is that from a strict reading of the provision, even that is not permissible. It should go directly into a account maintained especially for corpus. This is an amendment which has been made to 11.1d itself. The another amendment which has been made. So this amendment to 11.1d has been made with effect from assessment year 22-23. With effect from assessment year 18-19, there is a provision that corpus donations made out of deemed application will not be treated as donations, will not be treated as application. So here the question, let me explain a little illustration. I am a charitable trust registered under 12A, 12AB. X is a charitable trust also registered under 12AB. Y is a charitable trust also registered under 12AB. I make a corpus donation to X. Because it is a corpus donation under 11(1)(d), X can claim it as exempt without making any application. X takes the same amount and makes a corpus donation to Y. Y can also claim it as exempt without making any application. Again, it can come back to me as a corpus donation, and I can also claim it as exempt without any application. This kind of round tripping permitted me to convert a non-corpus donation into a corpus donation, and thereby claim an exemption without making any application at all. The problem was actually much bigger. Even in the case of non-corpus donations, I would receive a donation. I would not apply it in the same year. I would accumulate it under 11(2) by filing Form 10 for 5 years. When that period was about to expire, I would transfer it to another trust. He would accumulate it under 11(2) for 5 years. He would transfer it to another trust, and so on. So everybody was claiming application towards charitable purposes, but no actual charitable activity was taking place. This is round tripping. So now, so this was what was prevented by an amendment to 11(2) much earlier, and now it says that if I make a corpus donation to another trust out of my deemed application, then it will not be treated as application. Now, what is deemed application? If I don't meet my 85% requirement, I have two options. Now it is very easy to explain because there is a form. The moment there is a form, everybody becomes aware of the provision. If there is no form, nobody is aware of the provision. Everybody was always aware of 11(2) because Form 10 was there. There is now a Form 9A, that is deemed application under clause 2 to explanation 1 to section 11. The difference between 11(2) and which we call accumulation and deemed application is that 11(2) is for 5 years, earlier it was for 6 years, but I say that very quietly, I come to it later. And deemed application is only for 1 year. Now out of this deemed application, if I make a corpus donation to another trust, it will not be treated as application. This is the amendment with effect from Asman here 1890. Two other issues arise on corpus. They are not amendments, but see, I'm here mostly because of my own academic enrichment that I gained from reading and speaking on this. So wherever a topic interests me, I trust that it will permit me to go down that tangent without sticking to the syllabus. A question arose before the Kerala High Court. One person made a donation to a trust saying that this donation is to be only for your corpus, which means it satisfies the 11(1)(d) test because it is a voluntary contribution made with a specific direction that it shall form a part of the corpus. I have read that provision so many times that without memorizing it, it comes only that because conceptually it can only be that, the words cannot be any different. Anyway. Then the donor also said that if you invest this in fixed deposits of bank, the interest from that shall also be only put into corpus. So the question that arose before the Kerala High Court was whether on that interest 85% application had to be satisfied or not. Kerala High Court held yes. With deep respect, I strongly disagree with this one. What is the requirement of the provision? The funny thing is in that judgment, the words of the statute have not been, dwelt upon sufficiently. Voluntary contributions. First is interest, a voluntary contribution. Who is paying you the interest? The bank is paying you interest as consideration for lending them the money. By Chand H. Gandhi, Bombay High Court, the relationship between bank and customer is that of debtor and creditor. So when the bank pays you interest, it is not a voluntary contribution. So at that level itself, this argument fails. Secondly, made with a specific direction that it shall form a part of the corpus. Logically, who can make a direction? The person making the voluntary contribution can only make a direction. Can I say that a donation which you make to a trust has to be corpus? No. So for those reasons, in my view, whether there is a direction of the donor or not, a corpus donation alone can come under 11(1)(d). But income earned out of a corpus donation must come under 11(1)(d). Last time I didn't know what happened, this time I learned. So this decision of the Kerala High Court, which I disagreed with, is Mata Amritananda Maimat, 85taxman.com, 261. Another question is often posed to us: what is the meaning of this corpus? If somebody gives me a donation and say put it into corpus, does it mean that I can never spend it? There is a wonderful decision of the tribunal. It's a 1985 decision in Dharma Pratishthanam's case. 1985 11 ITD 40 Delhi Tribunal, Dharma Pratishthanam. Tribunal says, see, a corpus is like a capital of a commercial concern. In the commercial concern you invest, tribunal does not say all this, I am saying all this, I don't want to discredit the tribunal with my own. In a commercial concern you invest the capital so that you can finance your business operations and make money out of it. But the capital also serves a secondary purpose, which is to protect you if a dark day comes. In the case of a charitable trust, the corpus serves only the secondary purpose, which is to protect you in the event of a dark day. One day, the charitable trust has no donations, but you have a lot of pending projects for which applications to be carried out. That is precisely why the corpus is there. Tribunal said the law cannot contemplate that even in that situation you cannot spend the corpus. So the tribunal very clearly said that there is nothing in the law which says that corpus cannot be spent. This it said in 1985. It is only in 2018 or so that the law itself recognizes it by saying that we will grant you deduction for application out of corpus in the year in which it is replenished. Which means that fundamentally application out of corpus is permitted. There is nothing that prevents you from doing it. In fact, I would advise assessees that if you receive a donation saying that it should be used, it should be credited to your corpus and not be used for any other purpose, please don't accept it. You are simply sitting on a pile of money which should not be used for any purpose. One day department will cancel your registration under 12AB, levy accredited income tax under 115 TD and recover that corpus. So rather than your object, only the objects of the government will be achieved. So application out of corpus is entirely permissible. I don't know, on my screen, I can see the time running on the top left of my slide and I am very concerned. It puts me under a lot of pressure. We'll see how much I can cover. Now, application out of borrowed funds. The principle here is very simple. You either earlier, what some assessees used to do, I would borrow a loan, conduct some bona fide charitable work, apply to charity, claim that expenditure as application. And in the time, in the year of repayment of the loan, I claim the repayment of the loan also as application. So, now this itself might not be a problem, assuming that I have offered the receipt of the loan as a gross receipt. If I receive loan of 100 rupees, I offer that 100 rupees as gross receipt, then I am entirely justified in claiming the repayment of the loan. Morally justified, legally it's a different question. Now what the law says is, listen, if you are making any application out of loan, you can claim it as application only in the year in which you repay the loan and to the extent of that repayment. Safely, correctly, because you know when you read these provisions when you are advising an assessee, you are looking for a loophole or a way through it. The first thought that occurred to me when I first started reading this provision was, if I have received a loan before the amendment, claim the application before the amendment, can I now claim also the repayment after the amendment because the amendment provides for it? Answer is no, there is a provision in the statute which specifically prevents that. See, there is also this old culture of, in Commission of Income Tax vs. T.N. Arvind Reddy 120 ITR 46, which I think a judgment, it is a judgment which every student of the law, every chartered account student must read. It's only 1.5 pages long. You will learn so much of the law from the judgment and you will understand how beautifully the language can be used to explain the law. 120 ITR 46. In that there is a reference to what Justice Krishna calls a dated culture of evasion versus avoidance. There have been, I mean, much before I got into practice, presumably also before I was born, there were 100 different ways to innovatively structure transactions to reduce the incidence of tax. One of the favorite instruments was HUF. There will be some people who will be a part of 15 HUFs. Each property will be in a different HUF. And there is of course the very famous case of judgments of the Gujarat High Court in Sarla Devi Sarabhai Trust. Some prominent personality, there were some 200 trusts and high courts were consistently upholding the claim for tax because the position of the law is that if you fall within this, if whatever you have done does not fall foul of the enactment, we cannot morally come and say, listen, what you did was wrong, therefore we will levy tax. So, there is a decision of the Supreme Court in Arvind Narottam. There is a concurring opinion of Justice Sabyasachi Mukherjee. The department always relies on a concurring opinion of Justice Chinnappa Reddy in McDowell's case, where he quotes Justice Felix Frankfurter, who said that by paying taxes, I buy civilization. Therefore, we must interpret taxing statutes strictly, and if there is no such thing as avoidance, there is only evasion. Justice Chinnappa Reddy in India upheld that view. In his concurring opinion, that particular proposition was not in the majority, but department still relies on it. Justice Sabyasachi Mukherjee, in a one-page concurrence in Arvind Malhotra, says that one would wish that one had the optimism of Justices Frankfurter or Chinnappa Reddy in saying that by paying taxes I actually buy civilization. And he says that we live in a nation of ostentatious government spending. So we cannot, by the payment of taxes, encourage the ostentatiousness of the few at the cost of the deprivation of the many. All this is of no academic relevance to us, but it gives us some joy to read these things, so we do. If that joy was not there, I might not even be in professional practice. Then, now this next inter-trust payments. If you are a trust or institution registered under 12AB and you make a donation or a payment to another trust registered under 12AB or 1023C, you can treat only 85% of that payment as application. This is a very, very problematic provision for certain categories of organizations. Now there is this sector of charitable entities who are fundraising organizations for other charities. There are some charitable organizations which have websites on which, say, if you are in Bidar, you are a charity operating in one village, say dealing with malnutrition. You don't have access to CSR funding, you don't have access to large funding sources. There are many charitable organizations, some commercial organizations, I don't want to name any, who run these operations by which they have portals on which you as a charitable organization can register yourself, and your cause and the object to promote will be listed on that website, and I as a donor can look through whatever charities are available. If I find one thing meritorious, I can donate to it. This is actually a real lifeblood for charities in mofussil areas who don't have access to large donations. So these intermediary organizations, they are themselves charitable. There are some which are carried out on commercial lines as profit-making private limited companies. Some of them are registered under 12AB. There is a decision of the Delhi High Court in Hamdard Laboratories which has held that if I am an intermediary funding education, my object will also be education, it will not be residually limited. So anyway, so for these charities, what they do, when a donation is made to them, they give ATG benefit to the donor, because the donor wants ATG benefit and the donor is not transacting directly with the ultimate organization. So ultimate organization cannot give the donor ATG benefit. This intermediary is not interested in the ATG benefit because it is a charitable organization. So the intermediary gives ATG benefit, collects the donation, passes the donation on to the ultimate organization. The law now says that if you pass on the donation to any other charitable organization registered under 12AB 1023C, then only 85% of that amount which you have paid will be treated as application. Most normal charities this will not affect. But charities in this field in this sector are completely, it has fundamentally become unviable because you have to start paying tax. Subject to some qualifications and caveat. Broadly, our advice to charities now is please don't claim exemption under 11 and 12. Do not claim registration under 12AB. Anyway, if you are operating on without profit motive, you don't distribute dividends, don't issue bonus shares, and don't distribute profits. You run it as a commercial entity on the face of it. If you are actually doing your operations well, you will not be earning huge surpluses anyway. If you are earning surpluses, pay 30% tax and get done with it. The moment you ask for anything from the government will make life very difficult. There are some problems with this suggestion in theory, and I have serious theoretical problems with this. But in practice, it will go through, and on those theoretical problems, we will discuss it in the appropriate forum. Finally, the other amendment is these disallowances under 40A1A and 40A3 for non-deduction of tax at source and for payments otherwise done by account pay, check, account pay, bank draft, electronic transfer. Those disallowances now apply equally to charitable trusts as well. Earlier, in my view correctly, there were various decisions of high courts. I have at least 20 decisions listed here. I think Karnataka High Court, Bangalore Tribunal, there are 2 decisions, Namma Sangha and Jyoti Charitable Trust. But the most, I think there is an old decision of the Mysore High Court. Siddharamanna Charities Trust, 96 ITR 275 Mysore High Court. But the more prominent decisions are Plot Shwetambar Murthy Pujak Jain Mandal, Gujarat High Court 211 ITR 293. In all these cases, they were saying that if in 1 year I had receipts of 100 rupees and application of 110 rupees, in the subsequent year I could claim that excess application as a deduction in computing the income of that year. Now, with effect from assessment year 21-22, by virtue of explanation 5 to section 11.1, that can no longer be done. Everybody always thought that the accumulation under section 11.2 was for, I won't say everybody, I'm unfair to those so most people always thought that the accumulation under section 11.2 was for a period of 5 years. But if you read 11.3, it used to say that if you have not spent the amount accumulated in 5 years or in the year following that, it will be taxed in that year. Which means effectively you had 6 years, 5 plus 1. Now the law has been amended and now you only have 5 years. The next amendment essentially says it's very simple. Application can now only be claimed on cash basis. Again, what happened when I read the provision, I thought, oh, if I claimed application earlier on accrual basis, can I now by virtue of this amendment claim it again on cash basis? The answer is no, there is a provision appropriately preventing that misuse. One other thing we must, in this context, as a measure of housekeeping within a charitable organization. Fundamentally, the law does not require you to follow accrual basis of accounting. Please do not follow it. I think as chartered accountants, we all know that because of the complications which are created at various levels, starting from the applicability of various accounting standards, applicability of ICDS, all of that hinges on following the accrual basis of accounting. So, if you are a Section 8 company, you have no choice. And subject to various domestic enactments, state level enactments which govern societies. But if there is no statutory requirement for you to follow accrual basis of accounting, please follow only cash basis of accounting. The difficulty arises where you receive some amount, you are entitled to receive some amount on a grant agreement, and the principles of accrual force you to recognize that as income, as revenue in a given year. But for whatever reason you don't receive it, then you are unable to resort to deemed application, you are unable to resort to accumulation also. Even before this accrual amendment, that was a problem. Now it is made even clearer that application will only be on cash basis. So if you are following accrual and you have accrued expenses in the form of application, your income will still be accrual because under 145 you are treating accrual as a method of accounting. But this amendment applies only to your application. So there is a problem there. Might be better off to change wholesale to cash basis, and if you are mandated by law, as in the case of Section 8 companies, to follow accrual, there have to be checks and controls to ensure that you don't get into this trap. Earlier there were assessees who were registered under both 1023C and under Section 12AB or 12AA. Now you have to pick one. In fact, it's not so much that you have to pick one, as it is that if you get registered under the other provision, the first registration automatically becomes ineffective. The substance of the matter is that you don't have the option each year of deciding whether you want to come under 1023C or under 11. Now this is the new registration regime. I will give you a couple of minutes to read this so that I can take a sip of water. There's not much value that I can add to this slide beyond reading what it says. So just bear with me for a minute. So let's look at the last 3 rows first. There is an old clause, so the application for registration is filed under Section 12A, subsection 1, clause AC, subclause, various subclauses as listed on this slide. If you look at the last 3 rows, old subclause 6 and new subclause 6 item A and B. These are cases where registration is being sought for the first time, having never been registered earlier. Under the old subclause, we will not deal with old subclause 6, we will deal only with the last 2 rows. New subclause 6, item A and item B. If you look at the second last row, that is 6A, under the column CIT's power, it says CIT has no power, he has to mandatorily grant provisional registration. This is a very interesting provision. It means that if your activities have not commenced and you are filing an application for registration for the first time under the law, then the commissioner is bound to grant the registration. He has no discretionary power not to grant it. Which is why I understand, subject to correction, this process is, this entire process is now predominantly electronic. But I also understand that if you make an application under this clause, the registration also comes through automatically, subject to correction. I don't deal with these matters in that manner. Except for this, in every other case, the commissioner has the power to consider the question on merits and decide whether to grant registration or not. What is also significant under the new clause, the subclause 6 item A, is the time at which you have to make the application. It says 1 month before the previous year of registration. Therefore, we are now in January 2024. If I make an application now, today, then I will get registration from assessment year 25-26. Because I have made the application 1 month, at least 1 month before the commencement of the previous year 24-25. If I make the application on or after the 1st of March 2024, I will get registration only from assessment year 26-27. This is, in my view, this is a very unfortunate provision, but as always subject to correction. From my reading of the statute, this is the position that emerges. So you must be very careful of this. At the stage of advising an assessee on establishing a charitable trust, you must not make a promise to him if he comes to you after March or in March that you can claim exemption under section 1112 straight away. This is of course subject to my broader comment earlier that please advise him not to claim exemption under section 1112. There were provisions both under section 1023C and under section 12AA as it stood before 12AB, and I believe for a brief period under 12AB, but certainly under 12AA, which said that if you file an application for registration and registration was granted on a certain date, and on that date assessment proceedings were pending before the assessing officer for any earlier assessment years, the benefit of registration can be granted to those assessment years also, which means there was a provision which effectively permitted retrospective registration for those assessment years for which assessment proceedings were pending before the year. Now that benefit is no longer available. Next, this issue of substitution of 12AB 4 and 5. This is a matter which has resulted in considerable controversy. Earlier, under 12AA and broadly also under 12AB, the test of whether registration should be granted was what are the objects of the trust and whether the activities, if available, are in accordance with the objects. The test of whether when the registration should be cancelled is whether the activities are not in accordance with the objects or whether the activities are non-genuine. This genuine is a very, very subjective term. It's very difficult to interpret. And the third one was whether the activities are not carried out in accordance with the objects of the trust. Broadly, these were the criteria to cancel registration. 12AB subsections 4 and 5 were substituted with effect from 1/10/2023. With effect from 1/10/2020, I will deal with the provisions as they stand only after this amendment.
With effect from 1/10/2023, the trigger for cancellation of registration is the occurrence of a specified violation. The term specified violation is also defined therein. To make about 6 or 7 items, I'll just quickly read them out. Where the income has not been applied for the objects of the trust, where the trust is carrying on a business and the business is not incidental or no separate books are maintained, which is essentially a violation of section 11(4), where there is a private religious purpose, where the income is applied for the benefit of any particular religious community or caste, where the activities of the trust are not genuine, which is same as it was earlier, where the activities of the trust are not as per the conditions of registration, this is another problem we'll come to later, and where any other law relevant to the activities of the trust are violated, this is another problematic condition, we'll come to it, and certain other circumstances. So, now with effect from 1/10/2023, in order to cancel the registration, the cancelling authority must satisfy himself that any one of these specified violations have taken place. Now, what is the process he must adopt? There are 3 triggers for cancellation. One is if the commissioner himself notices the occurrence of a specified violation, then he may, if the commissioner notices the occurrence of a specified violation during any previous year, he may cancel registration for such previous year and all subsequent previous years. The department is now saying, in various cases, one of which I am presently representing for the tribunal, that I may have noticed, as the commissioner, I may have noticed the specified violation in 2023, but the violation occurred in assessment year 2016-17. The specified violation took place during the previous year 31/3/16. So I am cancelling retrospectively with effect from that day. In my view, the meaning of this phrase during is relatable to the act of the commissioner in noticing the violation and not the occurrence of the violation. Therefore, 2 things must occur in the same previous year. The specified violation must occur and the commissioner must also notice it. It is not possible, in my view, under the law as it presently stands, for the commissioner to cancel registration with effect from assessment year 16-17 if he has noticed the specified violation only in a subsequent year. On this proposition, as I have interpreted it now, there are no direct precedents. But there are 2 orders of the tribunal, one of a Jodhpur bench in Pacific Academy of Higher Education, one of a Bombay bench in Heart Foundation of India. In both these cases, what the Honorable Tribunal has said is that for such previous year or subsequent previous year means that the cancellation can only be prospective. It cannot be retrospective. Therefore, they have simply said he has cancelled on this date. So it can only be from this date and not before this date. I don't think that is a proper construction of the provision. But the conclusion I reached and the conclusion they have reached are broadly the same, if not exactly the same. There is a recent order of the Bangalore bench of the tribunal in Amala Jyoti Vidya Kendra Trust, 157 taxman.com 235, December 2023 order. I will tell you what it says, but I will not tell you what I think of it because I have to argue this matter before the tribunal next week. So, sorry, I am not, with respect, I am not, I engage a senior counsel to argue. I don't want to be disrespectful to him. So, there are 3 or 4 decisions of the Supreme. There is a wonderful line of decisions, one of the Rangoon High Court, one of the Lahore High Court, etc. pre-independence. What is this assessment year previous year concept? Okay, let us start from the basics. There is no provision in the Income Tax Act except if you exclude that 115 series of sections. There is no provision in the Income Tax Act which levies a tax. In fact, section 3 or section 4 of the Act states that where any act levies income tax, it shall be levied in accordance with the provisions of this Act. The levy is not in the Income Tax Act, the levy is in the Finance Act of each year, which is why the rate is prescribed in the Finance Act of each year. So, how is this levy? Can I levy income tax today for income being earned today? No, because practically it is impossible. I cannot compute the income. So how does the income tax law work? I will levy income tax for a particular year in the next year. So if I am levying income tax in 1 year, I am levying it for the previous year. This is why the word previous year exists. And the law applies as per the assessment year. Because in an assessment year, if I am levying it for the previous year. On this basis, Rangoon High Court, Lahore High Court, and later on Supreme Court in Tasmania has 3 decisions, including one of a constitution bench in Isthmian Steam Ship Lines, has held that the law applicable to the Income Tax Act is the law in force in the assessment year. This is why if a Finance Act makes an amendment with effect from 1st April of any year, ordinarily it means that the amendment is with effect from the assessment year commencing on that 1st April. But this does not apply to provisions of procedure. Because provisions of procedure confer rights, jurisdiction, powers on the authority with effect from that date. Whether I am operating for assessment year 16-17 or now. Best example is the decision of Supreme Court in Ashish Agarwal in the context of reassessment. The amendments were brought about with effect from 1/4/2021. 148 was amended, 148A was introduced. Supreme Court said that the new law would apply to all notices issued after 1/4/2021. It did not say that the law would apply for assessment year 21-22 onwards, because that is not a charging or a computation provision. Thereafter, the Supreme Court upheld the views of all the High Courts, and thereafter, in exercise of Article 142(1) powers, gave directions precisely to the opposite of what all the High Courts held, precisely to the opposite of the reasoning it itself upheld. In my view, with deep respect, there is a great miscarriage of justice, but that is the law. As the Supreme Court says, it is not final because it is infallible. It is infallible because it is final. So, in Amala Jyoti Vidya Kendra Trust's case, the Bangalore Tribunal has said that this concept of specified violation has come into play only with effect from 1/10/2023. So, if you are to apply this concept for assessment year 16-17, you would be applying the law retrospectively, and the law is only prospective, therefore we will not introduce. In doing so, it has also relied on Heart Foundation of India. So, broadly, I understand, please don't hold me to this. Bangalore Tribunal is likely to follow Amjyoti Vidya Kendra in subsequent cases. We will see if I end up being lucky next week also. So, this is the law laid down. So, Amjyoti Vidya Kendra relies on Isthmian Steamship Lines and the decisions of the Supreme Court on this principle that the law is the law as it applies for the assessment year. So, I'll take it. Alright. So, as I said, there are 3 triggers for cancellation. I only dealt with the first one, which is the commissioner must notice the occurrence of a specified violation. The second trigger is under the proviso of the section 143(3). The assessing officer has the power to refer where in the course of assessment he finds out that it is possible that this trust is not entitled to registration at all. He has the power to refer the matter to the CIT to cancel registration. This power has always been there. But although, in my limited experience, I have not seen it used. And the third trigger is where, as per the risk management strategy of the board, the case is selected. That is pretty similar to what the process of scrutiny assessment. There are various other connected questions which cause problems in this amendment. If I were to hold that this amendment was entirely prospective, then can you say now that since the earlier provisions have been repealed, the commissioner now cannot cancel registration for any earlier assessment year and he can only cancel prospectively because there was no savings clause? So let's not go into that. I have answers to these questions, but it will only confuse things further. It doesn't serve the limited purpose of this seminar. So the commissioner, once the triggers are satisfied, he has to then conduct an inquiry, give an opportunity for hearing, and pass an order. He must pass an order within 6 months from the end of the quarter in which the notice is issued. My suspicion, all these limitation periods, if you look at 153 limitation for assessment, and also this, it is never 6 months or 12 months from any date relevant to the specific case. It is always 6 months or 12 months from the quarter or from the end of the year or I think this is because that is how they are able to organize their work better. Because everybody knows that as on 30th June, this many due dates are there, let us finish all this work. In fact, in one assessment against which I filed a writ petition for the High Court, the assessee filed elaborate documents at the stage of 143.2 notice, which you know will be issued 1-2 years before the assessment is complete. Not necessarily 2 years, depends on the period of limitation. But 142.1 will start coming only in the last 1 month before limitation. You won't believe this assessee. Every time 142.1 came, the assessee responded, submissions have been filed 6 months ago, no action has been taken at your end. Now you are giving me only 7 days opportunity, no reasonable opportunity to be heard, violation of principles of justice. I'm fairly opportunistic that on natural justice we will succeed before the High Court and get the matter sent back. But getting it sent back is not necessarily full relief. Then accreted income. I said a little earlier in the seminar that the moment you ask for something from the government, that is exemption, the government will ask for much more from you and make it fundamentally unviable. Now if you have been claiming exemption for many years and you tell the government, listen, I don't want this, please let me go, the government says no, you have to pay tax. 115 TD is what is colloquially being referred to as an exit tax for charitable trusts and institutions. Again, there are 3 triggers. The first is if you are converted into a form under which you are not entitled for registration under section 12AB, then this tax will be charged. There are some cases which subsection 3 of section 115 TD lists as being deemed conversion. One is where you amend your objects in a way that do not conform to section 12AB. The second is where your registration for 5 years is expiring and you have not filed an application for fresh registration within the relevant period, or if you have filed the application and it has got rejected, etc. There are so many cases of conversion. Then merger. Merger is where you merge with another organization, but that organization is not registered under 12AB or 1023C. Then also exit tax will get triggered. And the third is where you dissolve, but you do not transfer all of your assets to a trust or institution which is registered under 1023C or 12AB. Then also the exit tax will arise. I should just clarify as a side note that from the beginning, broadly, whenever I refer to 12AB, I am also referring to 1023C, so that reference may be read in even though I did not actually say it. There are some differences, very minor differences between the provisions which we will not get into. So, if these triggers are met and then the charge of exit tax takes place, it is an additional income tax on accreted income. The rate of tax is the maximum marginal rate. So, as I said, 115 series of sections are the exceptions to the rule that there is no levy in the income tax itself. Because it is only in this 115 series where you will see that there shall be a tax charge. So, if you look at the GST law, section 11 is the levy, 7 is the levy. 9 is the levy, 7 is supply, 11 is exemption. 9 is the levy. There is no similar section in the Income Tax Act except in this 115. So this is a section which levies a tax. So it is an additional income tax on accreted income chargeable at the maximum marginal rate. What is accreted income? So what is the time of charge? It will be charged at the, I will say it very broadly, it will be charged at the time at which any of these triggering events take place, conversion, etc. etc. So, potentially even if a conversion has taken place earlier, not before the section itself was introduced, and you are not paid tax on it until now, it is not subject to that regular assessment year wise system where 143.2 or 148 proceeding has to be initiated, etc. It is more similar to the TDS provisions under 201, for declaration of assessee in default. In fact, there is a specific provision for declaration of assessee in default in section 115TF. So 115TD is the charge and the collection. 115TE is interest. 115TF is penalty and declaration of assessee in default. So in this context, the assessment here also becomes insignificant, because the date of conversion or the time of conversion is what is relevant to determine the time of charge. Now, what is accreted income? Accreted income is defined to be the fair value of the assets as reduced by the value of the liabilities of the assessee, not assessee of the trust or institution. This fair market value is, the computation of this fair market value is defined in Rule 17CB of the income tax rules. It's not a very complicated rule to read. The only significant thing which I noticed there, which is a departure from 11UA and other similar rules, is that for immovable property it says the fair market value shall be the higher of the open market value or the stamp duty value. I don't recollect immediately how it is in 11U and 11UA. But now there is a distinction between stamp duty value and open market value. I think the difficulty that the bureaucracy faces is that, and to some extent it is a difficulty mirrored by chartered accountants and tax practitioners on this side, is that we each look at these things only from our own perspective. The difficulty that the bureaucracy faces is that it does not, it sees a problem, it sees a mischief which it has to plug hidden through, and it then implements measures to plug the mischief, but then is totally blind to the extent of the compliance burden on the assessment that results from those measures. It is very easy to be rash in our criticism of the bureaucracy on this point. To some extent that criticism may be warranted. But I think what the call of the hour is a more productive discourse from both sides and more open-mindedness and humility from both sides, and there can be some reasonableness in the compliance burden. See, the presumption of the law, the unstated presumption of the law is that you are a charity, you are conducting social service. Typically, you are not manned by professional managers, high-paid executives. And fundamentally, the law is trying to be more liberal to you. Now, the compliance burden on a charitable trust is incredibly high. It's simply not justified if you're carrying out a non-corporate style charitable organization. So, this fair market value is in Rule 17CB. I mentioned earlier that on this question of cancellation or granting of registration, if there were assessment proceedings pending before the assessing officer at the time at which registration was granted, the benefit of exemption will be granted to those years too. If, however, that benefit of exemption was not granted, even though those provisions were then in force, assets acquired out of that income will not form a part of the fair market value of the assets to be determined for computing accreted income. Now, how will I identify which asset was acquired out of what income? What if I have constructed a building by accumulating funds under level 2 and every year in form 10 declaring that I am constructing a building for 5 years, and out of that for 2 years this problem arises? It is, so there is, money is fungible, right? Bureaucracy seems to forget that. And agricultural income, any assets which you have acquired out of agricultural income which is exempt under section 10(1) will also not form a part of the assets and liabilities, value of assets to compute accreted income. In my view, there is a huge problem in this provision. Let us assume that I am enjoying registration from inception and my registration is subsequently cancelled. The cancellation attains finality. Reassessment proceedings are initiated for earlier years and demands are raised. Therefore, that income has fundamentally suffered tax by virtue of the reassessment. There is a provision in the computation of the accreted income which says that to the extent that you have actually paid taxes, a deduction can be claimed. And to the extent that refunds are due to you, whether you actually received them or not, that refund will have to be handled. Look at the double standards here, anyway. But the effect of this is Let us assume that I continue to litigate those reassessment proceedings for the Commission Appeals Tribunal in the High Court. Matter on the reassessment proceeding remains pending in the High Court. Cancellation starts one level higher, starts at the Commissioner. I go to the tribunal, I win or lose, I go to the High Court, assuming I lose. I decide not to go to the Supreme Court. The cancellation proceedings end before the reassessment proceedings end. Immediately I can bet you they will start on the recovery proceedings for the accredited income tax, even before a final determination is made on whether I am liable to tax on the reassessments for those years. The other difficulty is, since this accredited income tax collection is not regulated by a process of assessment, there is a process similar to the 201 process, as I said. But the section 105 TD itself says that it shall become due at what point. So it is not as if you have to file a return or they have to issue a demand notice. The section says it will become due. Typically it says that there are various circumstances, as I said, but let us take the case of the cancellation of registration. If the section says that the tax on accredited income shall become due within 14 days of the expiry of the period of limitation for filing an appeal before the tribunal under 253, where you have not filed an appeal, or 14 days from the order of the tribunal upholding the cancellation. Which means at this point, the liability or charge on me has already arisen. What happens if the 148 proceedings are still pending? Theoretically, he can declare me as an SCM default. Practically, he ought not to. But he will, and then you will have to challenge that again presumably in a writ proceeding. Secondly, in this case itself, it says that the tax will become due 14 days from the expiry of the period of limitation for filing the appeal before tribunal under section 250. It does not say that this time shall be only in a case where you don't file an appeal. What happens if I file an appeal with a delay and the tribunal condones a delay? Under the law as it stands now, the demand is already due. Then the question is, can the tribunal grant a stay on the demand? I will leave that question open. There is some complication there. We will get back to it later. Prima facie, yes. But before the tribunal stay is becoming, is not exactly a given. So the legal criteria for stay is 3 things: prima facie case, balance of convenience, and I forgot. Prima facie case, balance of convenience. Sorry, 2 things: prima facie case and balance of convenience. Practically, what that court typically says is, will you be in financial hardship if the demand is corrected now? So if that is the test laid down, then things get into a lot of difficulty. I don't know how many of you have watched the BBC serials from the 80s, Yes Minister and Yes Prime Minister. They stand equally true today. They are a remarkably accurate depiction of how the bureaucracy functions. Those shows are really hilarious for people like us who deal with the bureaucracy regularly. There is one scene in Yes Minister or Yes Prime Minister where the entire bureaucratic machinery gets very flustered because one pink color form was not filed and instead the blue color form was filed. What accumulation under 11.2? Form 10 has been around since 11.2 was around. Nagpur Hotel Owners Association, this is Santosh Hegde's decision in 2000 itself. What is the purpose of Form 10? What is the purpose of 11.2? If I think that I have a bigger project and I want to accumulate, my board or managing committee will pass a resolution, accumulate. Then I intimate the department, listen, I am accumulating this much and you are permitting me to do so under 11.2. So please give me the exemption for this for 5 years. I will spend it in 5 years. How are assessees using 11.2 now? Balancing figure. If my income is 100 rupees and I spent only 70 rupees, 15 rupees 11.2. So what has the statute done now to prevent this? They have said that Form 10 is to be filed 2 months before the due date for filing the return. The moment this amendment comes in the statute book, all of us look at it and say, look at how unfair the bureaucracy has been. On a wider consideration of the issue, it is us who have been unfair for all these years. as a charitable trust, the income tax law contemplates that you are bound to be spending your income on your charitable purposes. And if you cannot budget for even 2 months, then the fault lies with you. Members of the managing committee have come in, which means that I know that the time left is very little. I will do my best to do things quicker.
But there's a circular also which says that it can be filed on or before the.
Yes. Oh, sir, there are many complications. We'll come there step by step. Now, my question always used to be, what is the purpose of Form 10? Why do you need an additional form? In the return, anyway, you are saying that in 11 I am accumulating. And the return also now beautifully has all 5 previous years accumulation. So, what information are you gaining from the form? That purpose. That purpose you add one more thing in the return, make life easier. Honestly, I think that should be done even now. Why should you not permit the assessee to use it as a balancing figure? Anyway. So now this is the reason for this time limit. Similar time limit has been implemented for Form 9A deemed application as well. Second, the third time limit is for audit reports. Audit reports are now to be filed before the time prescribed under section 139, under 44AB. 44AB in turn refers to section 139(1). Next, belated return. There used to be this concept of provisional return in commercial. I mean, it is not found in the law, but in CA's offices there is such a thing called provisional return, where a business has a loss to be carried forward. You would say we file a provisional return now and then file a proper return after some time so that the loss is not lost. This, so now, section 12(1)(BA). So earlier, under section 12(1)(BA), you could file 12A(1)(BA), you could file the return within the period prescribed in section 139. 139, it said 139, there was an ambiguous circular of the CBDT. It said 139 means 139(4) also belated return, so that is also okay. Now, 12(1)(BA), with effect from 1/4/2023, which in my view is assessment year 23-24, permits you to file a return before the date prescribed under subsections 1 or 4 of 139. So the provision is more beneficial and there is no ambiguity. There is a circular, as I said, dated 23rd April 2019, before the provision read this way. And the provision referred only to section 139, which was liberal. But I think what is most interesting here is that there is in my view, a correct, albeit some may consider controversial decision of the Bombay High Court. This is of great assistance. Trustees of Tulsidas Gopalji Charitable and Chaleshwar Temple Trust, 207 ITR 368. Bombay High Court held that subsection 4 of section 139 is only a proviso to subsection 1 of section 139. Therefore, even where in those days the Act said that the return has to be filed within 139(1), even if it was filed within 139(4), it was okay. Because 139 subsection 4 is in the nature of a proviso to subsection 1. Now, you think this amendment to section 12A(1)(BA) would have sorted out the confusion. It has done so only in part. Because 12A(1)(BA) now permits you to claim the exemption. But subsection 9 of section 13, clause 2 of subsection 9 to section 13, says that you will not get the benefit of 11 to accumulation if Form 10 and the return are not filed within the due date specified under 139(1). So that provision has still not been correspondingly amended. Now, if I was a judge, I hope never to be a judge, that's a different matter. But if I was a judge in a High Court and I had the council produced Bombay High Court decision in front of me, I looked at it and said, correct, subsection 4 is a provision of subsection 1. What will standing counsel for the department argue? He will say, see, in 12A(1)(BA), Act has specifically said 139(1) or 139(4). Here it says only 139(1). Wherever the legislature has sought to permit a belated return, it has done so. Where it has sought not to, it has not done so. So, Bombay High Court is no longer relevant. This is a problem. Fundamentally, all of us have to ensure that it is filed before 139(1). 139(4) is not an option. So, this is the conclusion. Why these time limits Now you are not permitting a belated, please correct me on this if I am wrong, you are not permitting a belated return to be filed now after the end of the assessment year. If there is a time limit there, why would you again impose two separate time limits here? Why are you so keen on depriving the assessee of some benefit on some tiny procedural issue, which he was otherwise substantively entitled to claim? And which assessee has the patience to challenge these provisions on constitutional grounds like that? Whether the challenge will succeed or not is a different question. So this is why I quoted yes, Minister, because first of all there should be some form. Secondly, that there has to be a time limit for the form. Thirdly, the time limit is not satisfied. Some very large substantial benefit will deprive you of, because you want that form filed in time. I think something is protesting to my continuing. Now, the moment there is a form and time limit, what is the next thing in India? Everybody will file everything belatedly. I don't know if you have read orders of the Supreme Court in specialty petitions. 8 out of 10 orders of the Supreme Court specialty petition, the first line will be delay control. But always there will be delay. So, moment there is a time limit, everything will be filed belatedly, and the bureaucracy will realize that nobody will get exemption. So then immediately there is a procedure for condemnation of delay. Then issue notification after notification, circular after circular. One set will, for one class of cases, power will be in CBDT, one class of cases, power will be in Commissioner. Then that circular will be amended 3 times. Amending circular will be available, amended circular will not be available. So all that chaos I have tabulated in these 2 slides. Let me simplify it for you. There are 3 circulars towards the bottom of this page, 15, 16 and 17 bar 2020. These circulars are the most relevant for today. These govern 10B, 10BB, 9A and 10. At present, for current assessment year, there is no, to the best of my knowledge, I have done as much, I have put in as much effort as I can in understanding the law. With that I have corrected this amount of circulars. So imagine how much I don't know. So it is, in my humble understanding, there is no circular presently for controlling delay and filing of the return. 15, 16 and 17 address 10B, 10BB and 9A and 10. But if you file the return belatedly, you have to go to CBDT because there is no circular. Under section 119, CBDT has inherent power. We have filed application for CBDT. You will file the application, CBDT will not do anything. You will file a writ petition. High Court may either itself grant the relief or direct the CBDT to pass an order. Most people say we would rather pay the tax. Anyway, this PPT will be shared. So, section 13, I will finish in the next 5 minutes. Section 13, as I said earlier, is the provision which denies exemption in certain cases. 13(1)(c) is, so 13(1)(c), these provisions are quite amusing in themselves. 13(1)(c) used to say that if you apply your income in favor of certain related persons, it's called specified person, but I am using the word related person just for the ease of understanding, and that is not reasonable, then you will lose exemption. This test of reasonableness is the same test you will apply for 48 rupee. I don't know in how many cases the department has successfully upheld the disallowance up to the High Court in 48 rupee. I don't think, in my limited reading I have not seen. 13(1)(c) is also a similar position. So, the law as it read, plain textual interpretation was that if there is a 13(1)(c) violation, you will lose exemption for the whole of your income, not the income which is applied in 13(1)(c). Similar was the provision in respect of 13(1)(d), which is a violation of mode of investment, that is if you are investing in modes other than section 11.5. Fortunately, somebody in the bureaucracy woke up one day, read this and thought, okay, this is crazy, and now they have said that you will be taxed only in respect of that portion of income which has violated 13(1)(c) or 13(1)(d). Even before this, see, when cases like this go to the High Court, their conscience is shocked by the fact that the consequence is so disproportionate to the violation. So, although the plain words of the statute said that, there are numerous High Court rulings. I think Father Miller's charitable trust is Karnataka High Court, where it has been held that only that portion of the income will lose exemption, although the statute said the opposite. Now, there is clarity. There is a very interesting question. If I lose exemption, will I be allowed deduction for application? I will only ask questions here. I am not going to give any answers. It's very controversial. as accountants, we all know what is the difference between below the line and above the line. That is a charge to profits and an appropriation of profits. Is an application of income a charge to profits or an appropriation of profits? And therefore, will I or will I not be entitled to deduction thereof if I am not entitled to exemption under section 11 and 12? I don't want to answer the question consciously. Section 1310 addresses this issue in part. It says in certain circumstances where you lose exemption, the income will be computed in the following manner, and then it says deduction for expenditure, application, etc. will be allowed. Subject to certain conditions, it must be applied within India, it will be allowed only on cash basis, it should not be applied in favor of another trust, and so on. But 1310 applies only to the following cases: A, where the proviso of 215 is violated; B, where there is any failure with respect to maintenance of books of account or getting the accounts audited. And that's all. And then, yeah, so that is 1310. Remember, I told you at the end of section 13 there is one random explanation which has some definitions. Until recently it had only one definition, which is trust will include legal obligation. Now it has a definition for the term relative, which means there are three definitions, at least to my knowledge, in the Income Tax Act for the term relative. One is in section 2, one is in the explanation to 5627, which is now 56.10, and one is here. So please be careful on which definition you apply. And section 13, the last few subsections are very significant and very damaging, and often we tend to skip them. 13.7 is a very interesting subsection. It says that no exemption shall be available for anonymous donations governed by 115 BBC. Because you could have argued that okay, there may be a charge and a levy under 115 BBC, but it's still exempt under 11 and 12. So 13.7 clarifies that. 13.8 says that in the proviso to section 215, on which we have learned more than we need to in the beginning of this seminar, if that proviso applies, you will lose exemption for the whole of your income. And 13.9, which I have already dealt with, that is, if you cannot get 11 to accumulation, form 10 or return of 5, believe me. This covers the syllabus, so to the extent that I had promised it to you, which is recent developments in the Income Tax Act governing charitable trusts. There are various other provisions on the law of charitable trusts which practitioners are not often very well acquainted with. I will deal with one for 30 seconds and then I will yield to questions and to the whoever is presiding. There is a decision in Al-Amin Foundation of the Bangalore Tribunal, and there are earlier decisions which have held. So there is 11 subsection 1A, 1 capital A, which deals with capital gains in the case of charitable trusts. Broadly it says that if you reinvest the net considerations earned from the transfer, subject to some formula, in acquiring another capital asset, then the capital gains will be exempt. Bangalore Tribunal has held that you have two options. Either you can go under section 11.1A or you can go under the normal provisions of section 11.1 and claim 85% application. In my view, that is correct. But the fact is that in every nook and corner of the law governing charitable trusts, there is some nuance to be found. That is the only reason I enjoy dealing with this subject of the law. It is quite similar. In fact, in its scope, it is only somewhat less wide than the provisions governing international taxation in section 9. The reason that is wider is because that law evolves around the world and this law evolves only here. To conclude, my submission is, these laws cannot afford to be this complicated. Section 9 has to be that complicated because it goes into questions of state sovereignty, the extent of the jurisdiction of a state to levy a tax in respect of subjects which are beyond its territorial jurisdiction. There you cannot avoid the complexity. And there you cannot also avoid the complexity because the propensity for evasion is much higher. But in the context of sections 11 and 12, I think the law has to be significantly simpler because the Parliament must recognize that the compliance appetite of non-governmental organizations in charitable trusts is significantly lower than those who can engage highly paid chartered accountants and lawyers to advise them, as in the case of international taxation. On what is a very sad note, I will end. The only people who gain from this law being complicated are people like us. For now, I will stop. If you have questions, I am open to receiving them. Whether I will answer them is a different question. Subject to that, I will. thank you once again for not asking questions.
So I have one question.
Yes, sir.
This 10 pp has made mandatory from this 2023
Yes.
for charitable trusts. So when one of our clients witnessed and 510b, though it's a complicated, which has more details rather than compared to 10pp.
Yes.
So now like we have got an intimation and 143 proposing the addition. So we think we have an option to file a letter of condoning the delay. Any other options, sir, for doing with this?
There are decisions of the Bangalore Tribunal holding that the question of whether exemption is allowable under Section 11 is a debatable issue, which the CPC cannot under 143(1) pass orders on. I think Bangalore Tribunal is certainly there. There are also decisions, I think, of the Ahmedabad Tribunal. So that is one argument. But so theoretically, you have committed a violation because you are required to file one form, you file the other form.
Yeah.
The only remedy to it is to now file the correct form and file an application for condonation of delay. Strategically, from a practical standpoint, in such situations, you should do all possible remedies so that no way they can attack. So you should file the correct form, file an application for condonation of delay, simultaneously file a rectification application for 143(1). Depending on the stakes and the size of the SSC, you could consider a writ petition, but I will not advise that except as a last measure of last resort. I am not here to increase the professional practice of any advocate. So simultaneously you should file a 154 application. Actually, and you should also file an appeal. You should file an appeal contending that is a debatable issue not determinable under 143(1). You should file the 154 application on that ground, which is itself in my view a mistake apart from the record, and also on the ground that my compliance, if anything, has been more than what is sought, and file form 10b and condone. One of these things you will win. Ultimately, karma wins.
We can't file rectification before the CPC.
No, so you have to seek that the matter be transferred to the jurisdiction level, file rectification before him. Only then you get disposed of. The other option is you file 15 rectifications before CPT. Eventually CPC will realize that we have to transfer it.
The transfer into jurisdiction will take time, right?
Yes, it will take time.
2 years or something.
Not necessarily 2 years. In some cases it takes place faster, in some cases it takes place slowly. But to be honest, that is not my field of expertise. I do the drafting and somebody else for so does the filing. Somebody has already clapped, so at this point I think thank you very much for the patient hearing. As an advocate, I appear before judges, and even they often do not give me hearing as patient as this. If everything positive that has come here is the consequence of the law and the illuminating judgments of the courts, everything negative that has come here is mine. Thank you.
The recent amendments with respect to the charitable trust under income tax laws and stringent provisions and compliances to be adhered to vis-a-vis the amount of fees received for the work done by professionals need to be looked into properly. Do not take provision for granted just because the trust you are auditing is known to you for many years. A caveat for all of us. Let us do justice to the law of the land. With that note, a round of applause for Bharadwaj Sheshadri. On behalf of members present here and all the managing committee members of Bangalore branch, I would like to hand over a memento as a token of gratitude and respect. Can I request Raj Gopal sir, the past chairman of Bangalore branch, to come out to dais and then do the honors. With that, thank you one and all for your support. I, CA Bharadwaj Sheshadri, Secretary of the Bangalore branch, sign up. Thank you.